Welcome to the Deep Dive, your dedicated space for unraveling the complexities of knowledge and finding clarity in the fascinating, often bewildering world around us.
Glad to be diving in.
Today, we're taking a truly personal deep dive, one specifically requested, actually, to help you understand something incredibly fundamental to your financial well-being. We're talking about the part of your finances that lives entirely in your head.
Indeed. And we're not just about the numbers on a spreadsheet here. We're really about the feelings, the stories, the silent decisions that truly shape our financial lives.
Yeah.
Consider this your invitation, really, your cozy space maybe, to reflect on the most intricate, confusing, and often, let's be honest, frustrating aspects of your finances.
Okay, so today we're pulling back the curtain on one of the most powerful and really sneaky cognitive biases that consistently messes with our money.
It really does.
Mental accounting. It's this kind of invisible force, a series of hidden money traps that you've probably fallen into a dozen times without even realizing it.
Oh, easily.
Shaping your spending, saving, investing habits in ways you might not even recognize.
It's precisely what makes, say, a $20 bill feel entirely different, depending on whether it came from your hard-earned paycheck, or maybe a surprise birthday card, or that tax refund.
Right, different buckets.
Exactly, different buckets. It's the subtle, silent bias that can paradoxically make us feel flush with cash right after a huge splurge.
Which is weird.
It is weird, and yet feel incredibly poor even after we've just made a significant profit, simply because of how our brains categorize these funds.
So what we're diving into is this deeply human tendency to develop and make financial decisions based on purely mental categories, these sort of arbitrary labels we assign to money.
Arbitrary is the key word there.
And here's the kicker. An economist would tell you money is fungible, meaning every dollar is interchangeable. It doesn't come with labels.
Right, technically.
But our brains, well, they seem to love their labels, don't they? And that's where the fascinating friction begins.
It is. It's where the psychology really clashes with the economic theory. Our mission today is to equip you with the insights and tools to master your financial story.
Okay.
To move beyond these unconscious biases towards, conscious, empowered action.
Good.
This deep dive will hopefully educate, inspire, and empower you, showing that understanding our inherent psychological makeup offers real, accessible solutions to navigating these traps that, honestly, are everywhere.
Okay, let's truly unpack this then. What exactly is mental accounting? It sounds a bit technical, like something only an accountant would deal with.
Right. The name is a bit misleading, perhaps.
Yeah, but from what you've hinted, it's actually profoundly human and impacts all of us.
You're spot on. It's a core concept in behavioral economics.
Yeah.
Basically, mental accounting describes how we humans categorize, evaluate, and mentally track our financial activities.
How we do it, not how accountants do it.
Exactly. Based on subjective criteria, like where the money came from or what we intend to use it for. So fundamentally, it's this idea that we place different psychological values on money.
Psychological values. Okay.
Which leads to what economists would often call irrational decision-making. We assign money to different mental accounts or buckets, each with its own set of implicit rules for spending and saving.
Rules we probably don't even articulate.
Usually not. They're often completely separate from money's actual fungible nature.
So if I'm hearing you correctly, a dollar is absolutely not always a dollar in our heads, even if it is, objectively in reality.
That's the crux of it. Yep.
Is that why someone might, say, have high-interest credit card debt racking up huge interest charges? But they also have a savings account, maybe earning very little interest, and they'd never dream of using the savings to pay off that expensive debt.
Precisely. That's a classic textbook example of mental accounting at play. According to mainstream economic theory, as you said, money is fungible.
Right.
It doesn't come with labels. It's mutually exchangeable. Richard Thaler, who really popularized this concept in his seminal 1999 paper, Mental Accounting Matters, he emphasized that individuals should, logically, treat all money the same.
Logically, yes.
Regardless of its origin or intended use. Yet, as you've just pointed out with the debt example, we consistently violate this principle.
So that credit card debt gets mentally assigned to what, a bad debt account we feel stressed about?
Yeah, something like that. An account we resent, maybe feel guilty about.
Yeah.
While the savings might be in a sacred, safety net account we're terrified to touch.
Even if touching it would save us a ton of money in interest payments.
Exactly. Even if it's financially illogical not to use the latter to reduce the former, the mental barrier is just too strong.
You described it earlier as an invisible force.
Mm.
Can you paint a clearer picture of what that actually feels like in a real person's mind day to day, beyond just the definitions?
Sure. Imagine this. You receive some unexpected income, perhaps a work bonus you weren't counting on, or maybe a small inheritance, even just finding money on the street.
Okay.
What's the immediate feeling? For many people, it's a sense of, ooh, free money.
Right.
Yeah, play money. Play money, exactly. You might mentally assign it straight into a discretionary spending account or maybe a guilt-free splurges drawer in your head.
Totally separate.
Totally separate. It feels fundamentally different from your regular paycheck, which is, rigidly and necessarily allocated to rent, groceries, bills, the serious stuff.
Yeah, that paycheck money feels heavy, obligated.
Obligated, necessary, non-negotiable. While the bonus feels light, exciting, maybe even a bit frivolous, like a personal gift you can indulge in without consequence.
That's it, that feeling of no consequence.
That's the internal accounting system hard at work, creating these emotional inconsistencies that constantly lead us towards irrational decisions, even when, our logical brain kind of knows better.
Here's where it gets really interesting for me. This emotional inconsistency is the first big clue that mental accounting is pulling the strings.
It really is.
It's the reason we might justify buying, say, an expensive concert ticket with that bonus money, while simultaneously stressing about making ends meet for our regular monthly expenses. It's not about the absolute amount of money we have. It's all about the mental bucket we've instinctively dropped it into.
You've nailed it. The label overrides the logic.
This isn't just some abstract theory, then. It's woven into the very fabric of our financial lives. So where did this all begin? How did our brains get so, tangled up with these invisible money labels in the first place? It feels so ingrained.
It is deeply ingrained. To understand this, we really need to take a step back into, deep human history. For most of our existence as a species, money as a fungible, abstract concept simply didn't exist in the way we understand it today.
Right. No dollars, no pounds.
Exactly.
Yeah.
Our ancestors operated on a system of bartering, reciprocity, communal resources. Value was incredibly fluid, highly contextual, based on immediate need, social relationships, and crucially, the origin of the resource.
Okay, give me an example.
Think about it. A common animal hide might be used for warmth or basic shelter without much second thought. Practical use.
Right.
But a hide from a particularly challenging hunt, maybe one with ritual significance or one gifted by a respected leader, that same physical object might be treated very differently.
How so?
It might be mentally elevated, used perhaps to create a ceremonial drum, a symbol of status, or traded for something far more valuable than its purely practical worth. Same object, different mental account.
So its origin and purpose changed its perceived value, even if it was physically the same.
Precisely. Its value and purpose were mentally categorized based on its source and significance. Our brains are, in essence, still running on this ancient software. We're wired to categorize resources and attribute different values and uses based on perceived source or purpose.
Even when we're dealing with modern, fungible currency.
Exactly. Even when that software is kind of outdated for the modern financial world.
So this isn't a moral failing, then, or some kind of personal flaw, if we treat our bonus differently from our salary.
Not at all.
It's a deep-seated cognitive habit, maybe even a cognitive fossil, that we've inherited from a time way before fungible currency even existed.
That's a great way to put it, a cognitive fossil. It's a survival trait adapted for a world of finite, non-interchangeable resources, which now, in our complex world of finance and endless consumer choices, often works directly against our best financial interests.
It's a fascinating paradox, isn't it? This ancient wiring in our modern lives.
It truly is. And this cognitive habit is underpinned by some fundamental psychological forces, primarily framing and loss aversion.
Okay. Framing and loss aversion.
Exactly. Nobel laureates Daniel Kahneman and Amos Tversky were the absolute pioneers in exploring these phenomena through their groundbreaking work, which became known as prospect theory.
Prospect theory, right.
Their research really revealed how our decisions are frequently swayed by these cognitive biases and mental shortcuts or heuristics, fundamentally challenging that long-held economic assumption that we humans always act rationally, like calculators.
We are definitely not calculators. What's fascinating here is how the presentation of information, what they called framing, can completely shift our perception of risk and value. Even when the underlying problem, the core facts, are identical. It's like, putting the same object in a different wrapper and suddenly seeing it as something else entirely.
It's an incredibly powerful effect, and often quite subtle. Consider their famous age and disease problem experiment. It's a classic.
Okay, walk us through that.
So the scenario presents a hypothetical disease expected to kill 600 people, and participants are offered 2 programs to combat it. Now watch the framing.
Right.
When presented with a survival frame, where the focus is on lives saved, Program A guarantees that 200 people will be saved. Program B offers a 13 probability that 600 people will be saved and a 23 probability that no one will be saved.
Okay, a sure thing versus a gamble.
Right. In this framing, a significant majority, around 72% of respondents, chose Program A. They prefer the certainty of saving 200 lives. That's risk-averse behavior when dealing with gains, saved lives.
Makes sense. Saving lives feels like a gain.
Now, here's the twist. When the exact same problem was presented to a different group, but with a mortality frame, focusing on lives lost, Program C guarantees that 400 people will die, which is the same outcome as saving 200. Program D offers a 13 probability that nobody will die and a 23 probability that 600 people will die. Same gamble as Program B.
Okay, same outcome, just worded differently, focusing on the loss.
Exactly. And here, the choices flipped dramatically. An astonishing 78% of respondents chose Program D, the gamble.
Wow, so they became risk-seeking?
They became risk-seeking when faced with losses. They were willing to gamble for a chance that no one dies, even though it meant a higher chance of everyone dying, rather than accept the certain loss of 400 lives.
That's incredible. The problems are mathematically identical in terms of outcomes. Saving 200 people is the same as 400 people dying out of 600. But just changing the frame from gains to losses completely reversed the common choice.
Completely. It clearly illustrates that the frame matters, arguably far more than the objective reality when we make decisions under uncertainty. And they found this consistently across diverse groups, students, university faculty, even experienced physicians.
So how does this powerful framing effect translate into our everyday financial lives? I can see it in advertising, maybe.
Oh, absolutely. It directly applies to how financial products are marketed and sold to us, and even how we talk to ourselves about money. Think about an investment product.
Okay.
If it's framed as, you have a 10% chance of losing a significant portion of your capital, people will likely be highly risk-averse. They focus on the loss.
Yeah, sounds scary.
But if the very same investment is framed as, this strategy have a 90% chance of preserving your capital while offering moderate potential returns, it suddenly feels far more palatable, safer, more attractive.
Even if the underlying risk is identical.
Even if the underlying risk profile is exactly the same, our perception is manipulated by the frame. The insight here is how deeply marketing, sales tactics, and even our own internal self-talk leverage these frames to influence our acceptance of financial risk and our spending decisions.
So we're really just responding to the packaging, the wrapping paper around financial choices, perhaps even more than the objective substance inside. That's quite unsettling, actually.
It is a bit unsettling, isn't it? And this phenomenon feeds directly into the core of prospect theory. As we saw, it describes how people make decisions under risk, often showing risk aversion when facing potential gains, but risk-seeking behavior when facing potential losses, all relative to some reference point.
A reference point, like our current wealth or maybe the purchase price of an investment.
Exactly. The theory highlights that our emotional response to a financial outcome isn't just about the absolute gain or loss amount. It's about how we perceive that gain or loss relative to that mental reference point. For example, the pain of losing $100 from your carefully built emergency savings account feels subjectively much worse, much more significant than the pleasure you'd get from gaining $100 from finding it on the street or winning a small lottery prize.
Even though it's the exact same amount of money.
Even though it's the same $100. Our brains don't just calculate the difference. They assign different value or utility, different emotional weight to those changes based on our internal framing and the mental account it affects.
And tied very closely into that, you mentioned loss aversion. I've heard this is incredibly powerful, maybe one of the strongest biases. Can you explain that in more detail and how it really manifests in our financial decisions?
Loss aversion is absolutely fundamental. It's the profound, deeply ingrained tendency we have to feel the pain of losses far more acutely, roughly twice as acutely, according to Kahneman and Tversky's research, than we feel the pleasure of equivalent gains.
Twice the emotional impact. Wow.
Yes. This isn't just a slight preference. It's a powerful psychological bias with massive financial implications. It often disrupts optimal portfolio rebalancing, for instance.
How so?
Because investors will often hold on to losing investments for far too long, desperately hoping they will recover back to the purchase price, their reference point, rather than cutting their losses rationally and reinvesting that capital more productively elsewhere.
Avoiding the pain of realizing the loss.
Precisely. This reluctance to realize losses is so prevalent, it even has a specific name in finance: the disposition effect. We dispose of winners too early to lock in the pleasure of a gain and hold on to losers too long to avoid the pain of a loss.
This raises such an important question. How do these powerful psychological forces, mental, accounting, framing, loss aversion, actually manifest in our everyday financial lives? Let's get into some specific, tangible examples of these hidden money traps in action. Okay, so that amazing feeling you get when you find, I don't know, a $50 bill in an old coat pocket you haven't worn in ages.
The best feeling.
Or when you finally get your annual tax refund check in the mail. That's a windfall gain, right? That immediate sense of free money that wasn't really expected or budgeted for.
Yes, precisely. Richard Thaler observed that people consistently violate that core fungibility concept when dealing with what he called windfall situations. Things like bonuses, tax refunds, lottery winnings, inheritances, even birthday money.
Yeah, gifts too.
Gifts too, absolutely. This money, because it's perceived as a gift or unexpected gain and not part of our regular hard-earned income stream.
It feels different.
It feels different. It's often mentally assigned to a completely different account. It's seen as less serious money somehow. And as such, it's frequently spent on more extravagant or discretionary expenses, things individuals might struggle to justify buying out of their regular, tightly managed financial plan.
I can absolutely relate to that guilt-free spending feeling. It's like stumbling upon a hidden treasure chest you didn't know you had, and the rules don't apply to treasure chest money.
Exactly. The rules feel suspended for that particular bucket. But of course, this can lead to some problematic spending habits if you're not careful.
I imagine so. How does this play out with something common like tax refunds?
Well, let's take the classic anecdote of the tax refunds.
Yeah.
Many people eagerly anticipate their tax refund, right? But they often don't view it as a simple reimbursement of taxes they overpaid throughout the year, money that rightfully belonged to them all along.
No, it feels like a bonus from the government.
Exactly. It feels like a bonus or a windfall gain. So they mentally assign it to a treat myself account, or maybe pay for that vacation account. Its spending is perceived to have no real impact on their core day-to-day financial plan.
Even though it's literally just their own money coming back to them.
Even though it's financially erroneous, it's simply money that was withheld from their regular income. In fact, some research even found that consumers are willing to spend a higher proportion of their tax refund when it's received as one big lump sum, compared to if the same total amount was dispersed in multiple smaller installments over time.
Why is that?
Because the lump sum feels much more like a distinct windfall gain, triggering that special money mental account. Smaller installments, on the other hand, tend to feel more like regular income that needs to be budgeted and managed more carefully. The framing of the payment matters.
And then there are the really dramatic, almost cautionary tales we hear about lottery winners. You'd think winning millions would set you up for life, but so often they end up worse off than before. How does mental accounting fit there?
Tragically, that happens far too often, and it's a stark, extreme illustration of mental accounting gone wrong. Lottery winners often spend their sudden, massive fortunes on dubious purchases, impulse buys, extravagant lifestyles they can't sustain.
Things they'd never have bought otherwise.
Never. And it's justified in their minds only by the unmerited nature of the prize. They've won house money, or maybe luck money, in the most literal sense. That money isn't integrated into a solid long-term financial plan based on sustainable principles.
It stays in the crazy luck bucket.
It stays in the crazy luck bucket, leading to reckless spending without real consideration for future financial security, taxes, preservation of capital. Many winners do go bankrupt shortly after, sometimes even within just a few years. The money was mentally categorized as play money or unearned wealth on a grand scale, and it evaporated. Research even points to luxury goods being a prime target for these windfall gains, precisely because the money is deemed guilt-free and outside normal constraints.
It seems like this mental accounting even creeps into our supposedly rational investment decisions, creating this illusion of safe money versus play money within our own portfolios.
Absolutely. It's incredibly common. Investors are highly prone to this money you can afford to lose variant of mental accounting. They might mentally or even physically designate an arbitrary amount of their investment capital, say 10% or £5,000, as play money.
What do they do with this play money?
They might use it to speculate on penny stocks, chase high-risk ventures, jump into trendy cryptocurrencies, basically gamble in the market. They often feel it's prudent to delineate this, perhaps telling themselves, okay, this is just my fun money, my Vegas fund. The rest of my portfolio is for serious, long-term goals.
It sounds sensible on the surface, like containing the risk to one small area.
It might seem sensible at first glance, like a way to quarantine risk, but it's a purely mental creation, an artificial segregation.
But this artificial segregation goes against true financial rationality, doesn't it? An economist or a purely rational investor would argue you should never put any money somewhere. It's highly likely to be lost, regardless of its mental label. Risk should be assessed for the whole portfolio.
Exactly. Every pound or dollar in your investment portfolio, regardless of the mental bucket you assigned it to, is still fungible capital that contributes to your overall net worth and risk exposure.
So what's the flip side of this play money?
The flip side is often designated as safety capital. This is the money people regard as money they need. The serious funds earmarked for critical financial purposes like a down payment on a mortgage, their child's future education costs, or, most commonly, their retirement nest egg.
And the problem is keeping these totally separate in their minds.
Yes, this arbitrary segregation means that negative returns, potentially huge losses from their play money account, don't mentally impact the perceived safety and stability of their safety capital. The loss feels contained to the fund bucket. This prevents a holistic, risk-adjusted view of the entire portfolio and can lead to illogical investment decisions overall. You might be taking far more risk than you realize when you look at the whole picture.
And there's a fascinating anecdote related to this, involving gamblers, that really vividly illustrates this house money effect you mentioned earlier.
Yes, it's a classic behavioral finance example. Professional gamblers, and even casual ones, often refer to money won from the casino as house money.
Meaning it belongs to the casino, not them.
Mentally, yes. They might even physically separate it, putting winnings in a different pocket from their starting stake, their own money. They literally treat each pile as being in a separate mental account.
And how does that affect their betting?
With this house money, they become significantly more risk-seeking. They're less averse to losing it because, psychologically, they perceive it as not really theirs yet. It hasn't been mentally integrated into their baseline wealth. A prior gain stimulates risk-seeking behavior specifically within that house money mental account. It's prospect theory in action on the casino floor.
Okay, let's shift gears slightly. Many of us use budgets, right? We create categories for expenses like groceries, entertainment, utilities. Is this a form of mental accounting? And is it a good thing? Or does it also fall into the same kind of trap? It feels like it could be both helpful and harmful.
You've hit on a really crucial point. Mental accounting isn't always detrimental. It can absolutely have a beneficial side, particularly when it comes to budgeting and self-control. Well, consciously setting up budget categories and sticking to them is a form of mental accounting. And rules like don't dip into retirement savings for everyday expenses or pay for luxuries exclusively out of a dedicated fund budget are mental accounting guardrails that can genuinely help reinforce financial discipline and prevent impulsive overspending.
So we're assigning different functions and maybe different levels of strictness to each asset group. Retirement savings, very strict. Entertainment, more flexible. Vacation fund, education fund, housing costs, etc.
Precisely. In that sense, mental budgeting helps simplify what can be very complex purchase decisions by limiting our choices and providing a useful internal framework for managing our desires and prioritizing our spending, just as Thaler described. It provides structure.
Okay, so that's the upside. What's the potential downside or the pitfall?
Well, there's a significant flip side. If these mental budgets are either too flexible, meaning we easily reallocate money between buckets, or too rigid, preventing sensible adjustments, things can go wrong. Consumers can fail to assign expenses to the right categories, or worse, they might create entirely new mental categories on the fly just to justify a particular spending urge.
Oh, this doesn't come out of entertainment or clothing. This is my special treat budget this month.
Exactly. Studies show that consumers are incredibly flexible, almost ingenious sometimes, in their mental accounting gymnastics. We're often quite willing to construct new accounts or creatively redefine existing ones just to legitimize a purchase we really want to make.
And what about small expenses? Do they fall through the cracks?
They often do.
Yeah.
Small, frequent expenses, what some call micro-splurges or the infamous latte factor, may get ignored or downplayed because they appear immaterial when compared to the larger mental budget categories like rent or car payment.
But they add up.
They absolutely add up over time, potentially leading to significant overconsumption without us fully realizing the cumulative impact on our overall finances. We nickel and dime ourselves into trouble without noticing.
Let's consider a classic thought experiment that perfectly illustrates the lost $10 bill versus the lost $10 movie ticket. Can you walk us through that one?
Sure. Scenario 1. Imagine you're on your way to the cinema, planning to buy a $10 movie ticket. Just before you get to the box office, you realize you've lost a $10 bill from your wallet. It's just gone.
Okay. Annoying.
Very annoying. The question is, would you still buy the movie ticket? Studies consistently show most people, around 88%, say yes, they would still buy the ticket.
All right, now scenario 2.
Scenario 2. Imagine you paid $10 for your movie ticket in advance, maybe online. You have the ticket in your pocket. But on your way to the theater, you lose the ticket itself. It's gone.
Oh, even more annoying.
Right. Now the question is, would you then buy another $10 ticket at the box office?
That feels different.
It feels very different to most people. In this scenario, far fewer would buy another ticket. Studies show only about 46% would buy a second one, meaning 54% would not. They'd just go home.
But wait, the financial reality is identical in both scenarios, isn't it? Either way, you're out $10 and you still want to see the movie.
Exactly. Objectively, you're $10 poorer than you expected to be. But psychologically, it's completely different. In the second scenario, the lost money was mentally assigned to the specific movie ticket mental account because you lost the ticket.
So buying a second ticket feels like...
It feels like paying $20 for that one movie. The cost in that mental account suddenly doubled. In the first scenario, losing the $10 cash felt like it came from a general cash or bad luck account, separate from the movie purchase itself.
That is a perfect, almost visceral illustration of how our mental accounts, not the objective financial reality, dictate our behavior and our emotional responses. It's truly eye-opening.
Isn't it? It shows the power of these invisible boundaries. And we also see interesting ways people use these mental accounts, sometimes deliberately, to lessen the psychological pain of losses or expenses.
Like that finance professor anecdote.
Exactly. There's this humorous anecdote about a finance professor who maintained a mental charity donation account with a target amount he planned to give. Now, whenever he incurred an unexpected annoying loss, say a speeding ticket or a minor parking fine, he would mentally deduct that specific amount from his intended charity donation for the year.
Seriously. So the charity paid for his speeding ticket, mentally.
Mentally, yes. He essentially framed these penalties not as personal losses, but as reductions to a future discretionary outflow, the donation. He viewed it almost like an insurance policy against these small, everyday annoyances. It made the immediate loss feel less painful by reframing it within a specific, more flexible mental account. It was a clever psychological coping mechanism.
That's certainly a creative, if perhaps lightly ethically dubious way to reframe a loss. I've also heard of people making expensive purchases feel less painful by mentally linking them very directly to a specific income source, almost like a one-to-one exchange.
Absolutely. That's another common strategy. Think of the anecdote, I believe Fowler tells this one, about a speaker who went on a rather expensive vacation to Switzerland.
Okay. Switzerland's not cheap.
Not at all. But the speaker had also earned some speaking fees from giving a talk while in Switzerland. Mentally, those specific Swiss-earned fees were directly accounted for, earmarked, to cover the outrageous prices of the Swiss vacation itself.
Ah, so the trip paid for itself in his mind.
Effectively, yes. It made the vacation feel paid for, or at least heavily subsidized by the trip's own location and activity. Now, crucially, if he had earned the exact same fee amount from giving a talk in, say, New York just before the trip, that money would not likely have been mentally assigned to the Swiss vacation in the same way.
What?
Because the direct topical link wouldn't be there. The New York money would probably go into a general income account. Consequently, the high prices in Switzerland would have felt far more painful and less palatable without that specific mental offset. The perceived geographical and temporal link created a specific mental account They cleverly softened the psychological blow of the expense.
And what about gifts? I've definitely experienced how receiving a specific, perhaps luxurious gift can feel far more special and enjoyable than receiving the equivalent amount in cash, even though they have the same objective financial value.
That's another brilliant illustration of mental accounting in action. And it really challenges those traditional economic assumptions that rational people should always prefer cash because it offers maximum flexibility.
So why do we often prefer the specific gift?
Consider a couple who budgets quite strictly, maybe allowing themselves only $10 per night for wine on average, and they never dream of spending more than, say, $20 on a bottle for themselves.
Okay, a common self-imposed rule.
Right. Now, if they receive a gift of an expensive, perhaps $80 bottle of wine for a special occasion, they'll likely savor it, appreciate it, and enjoy it in a way they never would if they'd simply received $80 in cash.
Why? What would happen to the cash?
The $80 cash would likely disappear into their general household expenses mental account, or maybe get allocated to savings or debt repayment. It wouldn't feel special. But the expensive bottle of wine, precisely because it's a gift, bypasses their normal self-imposed budget constraints on luxury items like fancy wine.
It's permission to indulge.
It's permission to indulge. The mental accounting here strongly suggests that the best gifts are often things that are perhaps more luxurious, more experiential, or more indulgent than the recipient would normally buy for themselves. Because the gift helps them circumvent their own internal budget rules and enjoy something guilt-free that their mental accounting system wouldn't typically permit.
Okay, so it's not just about the source of money, but also how things are priced and how we actually pay for them. It seems like these can also fall into mental traps, influencing our decisions in subtle yet really significant ways.
They absolutely do. Mental accounting impacts our purchase decisions at multiple stages.
All right.
Right, from considering the source of the funds we're using to the intended use of the item, the specific pricing strategies marketers employ, and even the physical or digital payment method chosen.
And all these add up.
All these factors ultimately influence our final purchasing behavior, the decision itself, to buy or not to buy, the quantity we end up buying, and sometimes even the quality level we opt for.
Let's dive into some pricing examples first. How do our mental accounts affect how we perceive prices and promotions? This feels like marketing 101, but with a psychological twist.
It really is. Consumers constantly evaluate price reductions, not in isolation, but in comparison to a reference price, which is usually the regular price they have in mind. This is tied to the idea of topical mental accounts. We evaluate the goodness of a transaction partly based on the specific item and its usual cost.
So the context matters hugely.
Hugely. And this leads to a preference for relative saving offers over absolute saving offers, even if the actual monetary savings are identical. For instance, saving $5 on a $15 item often feels like a much bigger deal, a more significant psychological win.
We're getting a third off.
Exactly. Than saving the same $5 on a much more expensive $125 item.
Even though it's still $5, say.
Even though it's still $5. Our brains seem to weigh that percentage discount, the relative saving within that specific item's mental account, more heavily than the absolute amount. This is where the psychophysics of pricing comes in a fancy term, basically meaning our perception of a price change isn't always rational or linear. The perceived value of a discount is heavily influenced by the context of the original price.
That's definitely why 50% off signs are so much more potent than $5 off. Signs, even if the $5 off is on a cheaper item and represents a bigger percentage saving sometimes. It makes perfect sense now through that lens.
Precisely. The percentage frame is often more powerful. We also observe what's called flat rate bias.
Flat rate bias, what's that?
This is where consumers show a consistent preference for flat rate pricing plans, even when a pay-per-use model would actually fit their needs better or be cheaper overall based on their actual usage patterns.
Like gym memberships you barely use, or maybe unlimited phone plans?
Exactly. We seem to dislike the uncertainty or the perceived complexity of pay-per-use, and we're willing to pay a premium for the simplicity and predictability of a flat rate, even if it's economically irrational for our usage level. We mentally budget the flat fee and feel safer.
And promotions and bundles, how are they designed to play on this?
Oh, they're carefully crafted to leverage mental accounting. Consumers react very differently to promotions depending on how they're presented. Sometimes people prefer a consolidated single bundle price because it simplifies the decision and feels like one transaction. Other times they prefer seeing transparent discounts on each individual product within the bundle because it makes them feel they're getting a specific deal on each item, maximizing the perceived savings across multiple mental accounts. Marketers test these framings constantly.
What about when we miss out on a really good deal? Does that experience affect our future decisions? Maybe preventing us from taking the next good deal if it's not quite as amazing?
It absolutely can. There's a fascinating phenomenon known as inaction inertia.
Inaction inertia, okay.
If you consider buying something, see an attractive promotion, say, for a new software subscription at 50% off, but you hesitate and miss it.
Happens all the time.
Right. Then later, you might see a second, less attractive offer for the same software, maybe at only 20% off. Objectively, 20% off is still better than paying full price. But you might find yourself completely passive, unwilling to act on the 20% deal. Your brain connects these two events within the same mental account for that specific software purchase. The initial missed gain from the 50% off deal creates a psychological inertia, a feeling of, I missed the real deal, that prevents you from acting on the subsequent, still beneficial opportunity.
So the memory of the better missed deal poisons the current deal.
Essentially, yes. It shows how prior outcomes, or even near misses, within one mental account can significantly influence and often impair our current choices within that same account. Past regrets shape present actions.
Okay, and how do payment methods themselves factor into this? You mentioned the pain of paying. Does swiping a credit card feel inherently different from handing over physical cash, and how does that affect our spending habits?
Oh, significantly different. This relates directly to the psychological pain of paying. Consumers consistently exhibit different purchasing behavior depending on the payment method used.
Credit cards being the main culprit for encouraging spending.
Often, yes. Credit cards cleverly decouple the moment of purchase from the moment of actual payment. When you swipe a card, the outflow of money is delayed, postponed, making it feel less salient, less immediate, less real somehow.
The connection is broken.
The connection is broken, or at least weakened. This reduces the salience and vividness of the outflows, as researchers put it. It makes the cost harder to feel and harder to recall accurately compared to the very tangible experience of counting out and handing over physical cash.
So that $50 gadget added to an already hefty $843 credit card bill just feels smaller.
It often feels much smaller and less impactful psychologically than if you had to physically pull out two crisp $20 bills and a $10 bill from your wallet and watch them disappear. That physical act creates friction and awareness. The psychological distance from the payment provided by credit cards is a critical factor in how we perceive the true cost of goods and services. And it very often leads to easier, less considered, and ultimately higher spending.
What about the whole idea of sunk costs? This feels closely related. That feeling that money is gone, spent, irreversible, but it still seems to weigh incredibly heavily on our minds and influence future decisions. I know I've struggled with this, holding on to something just because I paid for it.
The sunk cost fallacy is one of the most significant, pervasive, and often damaging mental accounting biases, and it's directly fueled by our powerful aversion to losses.
Okay, how does it work exactly?
It describes our tendency to continue investing time, money, or effort into a declining or failing asset, a project that's going nowhere, or even sometimes a relationship that's not working.
Why? Why keep pouring resources in?
Solely because of the amount we've already invested, rather than objectively evaluating the future value, potential, or prospects of that investment or situation. We're anchored to the past investment, not focused on the future outcome.
Like holding on to a stock that has consistently lost value.
It's exactly. Stubbornly hoping it will somehow rebound back to its original purchase price, just so we can break even and avoid crystallizing the loss. That kind of thinking can lead to far, far greater losses in the long run.
Because the money already spent is gone. It's sunk. It shouldn't matter to the future decision.
Rationally, it shouldn't. The money is already gone. It's a sunk cost. But the mental account for that particular investment remains stubbornly open in our minds, and the anticipated psychological pain of closing that account by formally realizing a loss is often just too great to bear. We prefer the hope, however irrational, over the certainty of a loss.
So that emotional attachment to our past investments, that desire not to have made a mistake, can really cloud our judgment, preventing us from making rational decisions based purely on future prospects.
Indeed. This deep-seated reluctance to realize losses is a powerful manifestation of loss aversion. As we touched on with the disposition effect, investors often exhibit this pattern. They're relatively quick to sell winning stocks to lock in a gain and get that positive feeling, that validation.
Yeah, feels good to take profits.
It does. but they simultaneously hold on to their losing stocks for far too long, often despite clear analysis favoring selling the loser to cut losses and free up that capital for better, more promising opportunities elsewhere.
And studies confirm this isn't just anecdotal.
Oh yes, numerous studies analyzing actual market trading data consistently confirm that investors are statistically more likely to sell their winners than their losers. They psychologically prefer to declare gains and avoid declaring losses, even if doing so is financially detrimental to their long-term portfolio performance. They're essentially delaying the psychological pain of admitting a past decision might have been wrong.
Wow. Okay, so mental accounting is clearly a huge player, maybe the star player in our financial decisions. But you mentioned it rarely acts alone. Are there other common cognitive biases that tend to intertwine with it, creating even more complex and hidden traps in our financial lives? It sounds like a whole team of biases working against us sometimes.
You're absolutely right. Mental accounting rarely operates in isolation. It's often amplified, exacerbated, and interacts with a whole host of other cognitive biases, creating a complex, tangled web of potential financial traps. Overconfidence is a really critical one to understand.
Overconfidence, thinking we know more than we do.
Exactly. It's where individuals systematically overestimate their knowledge, their predictive ability, or their degree of control over events, and it's absolutely pervasive in finance.
So this means thinking you're better than average at picking stocks, or timing the market, or understanding complex financial products, which can be incredibly dangerous when combined with mental accounting, I'd imagine.
Precisely. An overconfident investor might, for instance, trade excessively, constantly buying and selling based on their perceived insights, churning their portfolio and racking up huge transaction costs.
Wiping out any potential gains?
Often, yes. Or they might under-diversify their portfolios, putting far too much capital into one single stock or sector. They feel supremely confident about perhaps putting it all in their high-return growth mental account.
Ignoring the risks.
And they also tend to ignore or quickly dismiss contradictory information, data that might challenge their superior insights or thesis. This behavior, excessive trading, under-diversification, ignoring disconfirming evidence, tends to inflate costs, dramatically increase exposure to uncompensated risk, and ultimately significantly reduce net investment returns over time.
Can you give a quick example of how overconfidence plus mental accounting might play out?
Sure. Imagine Dan. Dan is utterly convinced, based on his own research or maybe just a gut feeling, that a specific small tech company is the next big thing, a sure thing. He's overconfident.
Okay.
Fueled by this conviction, he takes his entire £5,000 investment fund, maybe money he'd mentally earmarked as his get-rich-quick fund, and puts all of it into this single stock.
All eggs in one basket.
All eggs one basket. Then maybe there's a sector downturn or the company's product fails. In a tech bust scenario, Dan loses a substantial portion, maybe even all, of his capital. Now contrast that with Amy. Amy also has £5,000 to invest, but she acknowledges she doesn't know which specific stock will win.
She's less confident, maybe more realistic.
More realistic, perhaps better calibrated. So she diversifies her £5,000 across a range of assets, maybe some global equity, some fixed income, perhaps a bit in property funds. When the tech bust happens, her portfolio takes a hit, sure, but she's far less affected because her risk was spread out. Dan's overconfidence, combined with his sure thing mental account, led to a devastating outcome. Amy's diversification protected her.
That's a clear illustration. Now, we often hear about people getting fixated on a specific number, like a stock's past high price, even if that price is completely irrelevant to its current value or future prospects. Is that anchoring?
That's a perfect and incredibly common example of anchoring bias. It occurs when individuals rely too heavily, sometimes almost exclusively, on an initial piece of information, the anchor, when making subsequent judgments or decisions, even if that anchor is irrelevant, outdated, or completely arbitrary.
So if a stock was once trading at $100 a share during a market bubble, but now, due to fundamental changes in the company or in the market, it's trading down at $50. Someone caught by anchoring bias might still mentally view its true value as being closer to $100. They're anchored to that past high.
Exactly. They might hold on to it indefinitely, waiting for it to get back to where it should be, based solely on that historical anchor, ignoring current fundamentals, analyst ratings, or future prospects. This fixation can severely distort their valuation of the stock, their assessment of its actual risk, and the optimal timing for buying or selling.
Does anchoring apply outside of just stock prices?
Oh, absolutely. It can apply to personal finance goals, too. For example, someone might anchor to the arbitrary retirement age of 65, solely because that's the traditional age or the age for Medicare eligibility in their country.
Without considering their own situation.
Right. Without deeply considering other crucial factors like their individual financial needs in retirement, their specific investment strategies, the rising cost of healthcare, or the kind of lifestyle they actually desire. They're anchored to a number without assessing its personal relevance, which can lead to seriously suboptimal long-term planning.
It's also just natural, I think, to want to be right, to have our existing beliefs confirmed. But how does that very human tendency play out potentially negatively in our financial decisions?
That's confirmation bias. And it's another powerful force working in tandem with these others. It leads individuals to actively seek out, interpret, favor, and recall information in a way that confirms or supports their pre-existing beliefs or hypotheses.
So we look for evidence that proves us right.
Exactly. And crucially, we simultaneously tend to give less weight to, downplay, or even actively ignore contradictory evidence, information that challenges our viewpoint.
How does this interact with anchoring?
It often interacts very powerfully with anchoring bias. Once an investor anchors onto a specific stock price target or an investment idea, confirmation bias kicks in with force. They start actively seeking out news articles, analyst reports, online forum comments, anything that supports their initial conviction about that anchor.
And they dismiss the negative stuff.
They dismiss the negative reports as noise or biased. These biases, anchoring and confirmation, work together, collectively impairing the objectivity that's absolutely required for sound financial analysis and decision-making. It leads to a kind of tunnel vision. You only see the evidence that fits your desired narrative, which tragically reinforces potentially flawed decisions.
There's a strong social element to money and investing too, isn't there? That fear of missing out maybe, or just wanting to do what everyone else seems to be doing, especially when markets are going crazy.
Absolutely. That's herd behavior, or herding, in financial markets, and it's a potent psychological and social force. It occurs when investors start simulating and imitating the decisions of a larger group, often ignoring their own private information, research, or rational analysis.
Why do people do that? Why follow the crowd?
It can stem from a few things. Sometimes it's a belief that the crowd possesses better information. They must know something I don't. Sometimes it's social pressure. The fear of being left behind or looking foolish if you don't participate, FOMO. People tend to rely more on this collective information, the perceived wisdom or momentum of the crowd, than on their own individual assessment.
And the impact on markets.
This can lead to speculative bubbles, where asset prices get driven far above their intrinsic value simply because everyone is buying. Or, conversely, it can lead to rapid market sell-offs and crashes as panic spreads and everyone rushes for the exits simultaneously. Masses of investors pile into or out of assets, driven more by collective emotion, fear, or greed than by fundamentals.
So it affects risk and return.
Significantly. While herding can create short-term momentum that some try to ride, it often leads to irrational exuberance followed by painful corrections, or deep pessimism that causes markets to overshoot on the downside. It can cause many perfectly good, fundamentally sound investment opportunities to be overlooked or mispriced in the heat of the moment. It really highlights how powerful external social pressures can override individual logical analysis.
I can definitely relate to the pull of wanting something now versus saving patiently for later, or, putting off a task like planning for retirement because it feels so far away and less appealing than spending money today. Is there a specific name for that powerful psychological phenomenon?
There is. That's present bias, sometimes called hyperbolic discounting. It's our pervasive, deeply human tendency to favor immediate rewards, immediate gratification, over future benefits, even if those future benefits are objectively larger, more valuable, or more important for our long-term well-being.
So the instant gratification wins out.
The instant gratification often wins out. This bias can lead directly to impulsive spending rather than disciplined saving. Think about it. The immediate pleasure of buying that daily expensive coffee treat or the latest gadget seems more rewarding, more tangible, more real than the distant, abstract, hard-to-visualize satisfaction of having a larger retirement fund decades from now. It's the psychology of instant gratification in action. We place an enormous emotional weight on the present moment and heavily, often irrationally, discount the value of future events or outcomes.
And this undermines long-term goals.
It significantly undermines our willingness and ability to save adequately for retirement, to diligently pay down debt, or to consistently invest for our long-term future, because the eventual payoff just feels too far away, too uncertain to compete effectively with the allure of today's desires.
Wow. Okay. Putting it all together, it's crystal clear these aren't just isolated mental quirks or occasional mistakes. It's all part of a really complex interplay of deep-seated emotions, ingrained beliefs, powerful biases, and habitual behaviors that collectively shape our entire financial lives. Understanding these sneaky biases alongside mental accounting gives us a much clearer and, frankly, maybe a bit humbling picture of why we make the financial decisions we do, even when they seem illogical in hindsight. All right, so now that we have a much better handle on the what? The mental accounting, the biases like loss aversion, anchoring, overconfidence, and the why, the deep psychological and even historical roots. Let's get practical. Let's dive into the how. How do we actively, consciously break free from these hidden money traps and start taking real control of our financial story? Where do we even begin?
That's the crucial question, isn't it? How do we move from understanding to action? The first and arguably the most fundamentally important step is always cultivating awareness.
Just noticing it when it happens.
Just noticing it. The moment you catch yourself thinking or saying something like, oh, this money doesn't really count, or I can spend this because it's just my bonus, or maybe I absolutely cannot touch that specific savings account no matter what.
That's the red flag.
It's a red flag. You've identified a mental account boundary at play. That moment of internal clarity, that recognition of the bias in action, is your point of leverage. It's your chance to pause, reflect, and potentially pivot your behavior before acting automatically.
So awareness is the gateway. What's the core principle to aim for once we're aware?
The single most powerful antidote, the core principle to combat the pitfalls of mental accounting, is to consciously strive to cultivate a unified financial view. That means actively working to treat all your money, every pound, every dollar, every euro, as one single fungible pool.
Really internalizing that a dollar is a dollar is a dollar.
Exactly. A dollar is a dollar regardless of its origin, paycheck, bonus, gift, investment gain, or its intended future use. It all belongs to you. It's all part of your overall financial picture.
That makes so much intuitive sense. If all money is just money, it starts to strip away those emotional labels and arbitrary rules we attach to different buckets. So how do we put this unified view into practical, actionable strategies? How do we make it real?
One very practical and effective strategy is to deliberately streamline your financial accounts. Instead of having maybe 10 different savings accounts for 10 different goals or multiple checking accounts, try to maintain fewer, broader accounts.
Consolidate.
Consolidate where it makes sense. The primary goal here is to make it easier to view your finances holistically. Digital financial aggregation tools and apps are incredibly valuable for this.
The ones that pull all your info together.
Exactly. They allow users to see their total assets, their total debts, their income streams, and their expenses all in one aggregated dashboard. This provides a much clearer, unified picture, making more informed, rational decisions based on the whole situation much easier. It simplifies your financial landscape and consciously helps break down those artificial mental compartments your brain naturally wants to create.
And for a mental exercise, I really like the idea you mentioned earlier of visualizing this fungibility. It sounds like a powerful mental tool.
It can be incredibly powerful as a daily practice. Actively visualize your giant bucket of money. Take a moment and actually picture all your money, your regular paycheck flowing in, your savings balances, any bonus money, your investment values as all pouring into one single giant, potentially overflowing bucket.
One big pool?
One big pool. Now, when you consider making a purchase, paying a bill, or making an investment decision, visualize yourself simply taking money out of the bucket, not from a specific emotionally charged drawer labeled bonus money or play money or emergency fund. It's just coming from the overall pool.
How does that change the decision?
This mental shift forces your decisions to be based more on your entire financial picture, your overall goals, and affordability within the total context, rather than being dictated by the arbitrary and often misleading rules attached to the mental category your brain first assigned the money to.
Okay, let's talk budgeting. Many of us have tried traditional, often very restrictive budgeting methods, tracking every penny, feeling guilty about every small splurge. And honestly, they often end in frustration and failure, right? We just give up.
They very often do. Traditional, highly restrictive budgets can feel like financial straitjackets, and they often fail because they trigger psychological resistance or are simply too complex and demanding to maintain long-term.
So, is there a better, more psychologically aligned way to manage our spending? Something that aligns with our goals but doesn't feel like constant deprivation or warfare with ourselves?
Absolutely. Many find that adopting a conscious spending plan approach is far more effective and, crucially, more sustainable than those old-school, overly restrictive budgets. Instead of focusing on minute tracking and restriction, it focuses on dividing your take-home pay into four broad, purposeful categories that support both your future security and your present well-being.
Okay, what are the four categories?
First, fixed costs, which typically make up about 50–60% of your take-home pay. This covers all your absolute essentials: housing, rent or mortgage, utilities, core groceries, transportation to work, insurance premiums, minimum debt payments. This is the non-negotiable foundation.
Got it. The must-haves.
Second, investments, aiming for around 10% of take-home pay. This is money specifically and automatically dedicated to building your long-term future wealth contributions to retirement accounts, like pensions or 401ks, potentially individual stock or bond investments, money working for future you.
Okay, investing for the future.
Third is savings,
Yeah.
typically around 5–10%. This category is for funding your shorter to medium-term specific goals. Building your emergency fund is primary here, but also saving for things like a down payment on a house, a new car, a big planned vacation, or maybe further education. It gives tangible purpose to your saving beyond just retirement.
So fixed costs, investments, savings. What's left? That seems like a lot already.
What's left, usually around 20–35%, is the crucial psychological component: guilt-free spending.
Guilt-free. Tell me more.
This category is for whatever truly brings you joy, enhances your life right now. Dining out, hobbies, clothes you love, entertainment, travel, charitable giving beyond your fixed donations, whatever matters personally to you. The absolute key here is that once the first three categories, fixed costs, investment, savings, are funded according to your plan, this remaining money is yours to spend however you wish without a shred of guilt or needing to track every single penny. The internal mental accounting battles over discretionary spending are largely eliminated because the money is explicitly allocated for enjoyment.
This approach sounds incredibly liberating, actually. It ensures the essentials and future needs are covered first, systematically, but then it explicitly allows and even encourages guilt-free enjoyment of the present. It feels like a much more psychologically sustainable way to manage money rather than that constant feeling of restriction or deprivation.
It fundamentally is for many people. It aligns your spending with your values and priorities across different time horizons. And building on this idea of sustainable management, a really critical strategy is to focus your optimization efforts on the big wins rather than getting lost in the latte factor.
Meaning, don't sweat the small stuff so much.
Exactly. Agonizing over minor expense, trimming, trying to save a few cents per gallon on gas, clipping dozens of coupons for pennies off groceries, feeling bad about buying a coffee, consumes immense mental energy and willpower for truly minimal financial impact in the grand scheme of things.
Where should the focus be instead?
The real substantial savings opportunities almost always lie in optimizing the major cost categories in your budget. Things like housing: can you refinance your mortgage, move to a slightly cheaper area, get a roommate? Transportation: can you downsize a car, use public transport more, negotiate car insurance?
Yeah.
Healthcare: are you on an optimal insurance plan? Are you using preventative care? And high-interest debt servicing. These categories typically represent 70–80% of most household budgets.
So tackling those offers real leverage.
Huge leverage. Prioritize your energy on negotiating your salary upwards, systematically refinancing high-interest debt, especially credit cards, optimizing your tax strategies legally, and aggressively shopping around for better rates on major insurance policies: home, auto, health. These are the levers that create actual substantial financial breathing room and move the needle significantly on your financial well-being, far more than skipping a daily latte ever could.
We've all heard stories, or maybe even been that person who gets incredibly worked up about those tiny savings, right? Like the example you gave of Tommy, who is genuinely pissed he didn't save urine 12s per gallon on gas that one time, or double-checked if he already owned Yellowstone Season 5 on his streaming service before buying it again.
That obsessive focus.
He spent so much mental energy and frustration on these tiny, almost negligible amounts, while potentially much bigger opportunities for savings, or maybe even increasing his income, might have been completely overlooked because his attention was elsewhere.
That's a perfect illustration of misdirected mental accounting energy, or maybe just misdirected financial focus. These small, highly visible savings provide immediate but often misleading psychological satisfaction. They make us feel like we're being frugal and responsible, but they can easily distract us from the more strategic, less frequent, but far higher impact changes that truly transform our financial picture.
Okay, let's talk investing again. So many people fall into those traps we discussed, holding on to losing stocks way too long because of the sunk cost fallacy, or making emotional buy-sell decisions based on fear or greed rather than logic. How can we invest smarter and actively avoid these deep-seated mental pitfalls?
The absolute cornerstone principle for smarter investing, directly combating biases like anchoring and sunk cost fallacy, is to make your investment decisions based solely on future value and future prospects, not on past prices or your emotional attachment to an investment.
Easier said than done, perhaps.
It is easier said than done, which is why it requires conscious effort. Mental accounting constantly tempts us to make highly emotional decisions, especially when we anchor, maybe subconsciously, to a stock's original purchase price or its glorious past high. But you have to constantly remind yourself, the market does not know or care what price you paid.
It only cares about the future.
It only cares about the consensus view of potential future earnings, future growth, future risks. You must rigorously train yourself to recognize that money already invested is a sunk cost. It's gone, irrelevant to the next decision. Rationally, it shouldn't influence your future choices about whether to hold that asset or sell it. What truly matters now is its expected future performance relative to other available opportunities.
That's a really powerful mental shift, detaching from the past, focusing only on the forward-looking potential. And what about mitigating risk, especially when our natural overconfidence might be pushing us towards making overly concentrated bets in those play money accounts?
Well, the antidote to overconfidence and concentration risk is a classic timeless investment principle, yet one that's surprisingly often overlooked or underappreciated, especially during bull markets when everyone feels like a genius. And that principle is diversification.
Don't put all your eggs in one basket.
As the old wise adage goes, don't put all your eggs in one basket.
Yeah.
Successful long-term investing isn't primarily about hitting home runs or finding the next 10-bagger. It's fundamentally about patience, developing a sound strategy, and systematically managing risk over time.
How does diversification help manage risk?
Diversifying your investments across different, ideally uncorrelated or low-correlated asset classes, things like global equities, stocks from different countries and sectors, fixed income, bonds of varying types and maturities, real estate, perhaps through REITs, maybe some commodities, allows your overall portfolio to better weather the inevitable losses from any one specific sector, company, or region. It smooths out the ride and allows you to take more calculated rather than impulsive or overly concentrated financial risks. This directly counters the danger we discussed earlier, the overconfident investor like Dan putting all his capital into that one sure thing mental account and getting wiped out.
Okay, diversification is key. But making all these rational decisions, staying diversified, avoiding emotional trades, it still feels like a constant battle against our own biased brains. Is there a way to make this entire investment process easier, less effortful, and less prone to those daily emotional whims and biases we've talked so much about?
There absolutely is, and it's probably the single most effective behavioral finance tool available to the average person. That tool is automation. Make automation your most powerful ally in building wealth.
Setting things up to run on autopilot.
Exactly. Implement small, consistent, automatic behaviors. Set up recurring, automatic transfers from your checking account directly into your savings accounts and your investment accounts every single payday before you even have a chance to think about spending that money elsewhere.
Pay yourself first, automatically.
Pay yourself first, automatically. This significantly reduces the cognitive load, the mental effort required for financial decision-making. It removes the need for constant willpower, which we know is a finite resource, and instead leverages powerful, positive behavioral interventions. For example, the widespread adoption of automatic enrollment in workplace pension plans, or 401ks, has been incredibly effective globally.
Why is auto-enrollment so powerful?
Because people tend to stick with the default option due to inertia. When the default is to save and invest automatically, most people just go along with it. This simple set-it-and-forget-it approach leads to significant wealth accumulation over decades, simply by bypassing our daily biases, our procrastination tendencies, and our temptation to spend rather than save. Automation makes the right decision the easy decision.
It sounds like so much of this, whether it's budgeting, saving, or investing ultimately comes down to understanding ourselves better on a deeper level, cultivating that self-awareness you mentioned, and perhaps quite literally needing to rewire our brains to respond differently to money and financial decisions over time.
You've encapsulated it perfectly. Self-awareness is absolutely the crucial foundation for identifying your specific personal biases, your unique emotional triggers around money, we all have different ones, and the particular mental accounts you tend to create and rely on.
And the exciting part is that change is possible. We're not just stuck with these biases.
Exactly. The really exciting news from neuroscience research over the past couple of decades is that our brains are incredibly plastic, meaning they can change and adapt throughout our lives. Financial behaviors, even deeply ingrained ones, can be changed through deliberate, consistent practice and what psychologists call cognitive restructuring, actively challenging and changing the thought patterns that lead to biased decisions.
So we can create new habits, new neural pathways.
We absolutely can. We can create new neural pathways and learn to override those old, automatic, often unhelpful habits through consistent, conscious behavioral changes. It's not solely about exerting brute willpower, which often fails. It's much more about strategic self-awareness, consistent practice, and designing environments that support better choices.
Okay, so how can someone listening right now start actively cultivating this deeper level of self-awareness around their own finances? Where do they practically begin that process?
One incredibly effective, though maybe initially uncomfortable strategy is financial journaling. This isn't just tracking spending, it's deeper.
What does it involve?
Dedicate some regular time, maybe just 10-15 minutes a week, to not just document your significant financial decisions, big purchases, investment changes, savings transfers, but crucially, to also write down your thought processes leading up to those decisions. What were you assuming? What are you feeling? Anxious, excited, pressured, fearful?
Connecting the decision to the emotion.
Precisely. Reflect honestly on those feelings and mental states that influenced your choices. Over time, this practice helps you identify recurring patterns, hidden assumptions, and your personal constellation of biases. You essentially become a detective of your own financial mind, gaining profound insight into your subconscious triggers and automatic responses.
That sounds like building a really powerful internal feedback loop, making the unconscious conscious.
Exactly. It's about bringing it into the light. And building on that, actively analyze your past decisions, especially the ones that led to undesirable outcomes or feelings of regret. Don't just lament the loss or the mistake. Systematically reflect. What was your emotional state at the time? Which specific cognitive biases might have been driving the bus? Were there external influences or framings that swayed you?
Turning mistakes into lessons.
Transforming mistakes into concrete learning opportunities. Then don't be afraid to seek feedback. Actively engage with trusted, financially savvy friends, family members, or ideally, objective financial professionals. An outside perspective can often spot biases or patterns that you're completely blind to in yourself.
This also seems deeply connected to building a healthier, more empowering overall mindset around money, doesn't it? Moving away from feelings of scarcity, fear, or anxiety that often surround finances.
Yes, profoundly so. The internal state matters hugely. Actively work to cultivate an abundance mindset, or at least a mindset of sufficiency and capability. Try to view money not as a finite, scarce resource to be constantly worried about and hoarded, but rather as a tool, a resource that can grow, multiply, and be used purposefully to serve your goals and values.
How does that help counter biases?
This directly counters scarcity thinking, which research shows actually impairs rational decision-making and cognitive function, fostering anxiety and short-term focus. Complement this mindset shift by prioritizing those systems for automatic saving and investing we talked about. This removes the constant mental burden, the decision fatigue associated with deliberate financial choices day in and day out.
And you mentioned structuring our environment.
Yes, this is key. Build environmental structures that actively support your desired good financial decisions and make the poor ones more difficult or effortful. Think of it like designing your kitchen to support healthy eating.
How would that look financially?
It could mean creating physical barriers, like freezing your credit card in a block of ice if impulse spending is a problem. Or psychological barriers, like unsubscribing from tempting retail emails, deleting saved payment information from websites, or setting up specific spending limits or alerts on your bank accounts. Financial discipline isn't just about willpower. It operates like a muscle that strengthens with use, and a well-designed environment acts like a personal trainer, supporting its growth and making failure less likely.
So the good news is we're not just left adrift in this sea of biases, battling them alone with sheer willpower. There's actual science, behavioral science that we can lean on to help us escape these traps and build better, more robust financial habits.
Yes, absolutely. Behavioral economics doesn't just identify the problems. It also provides a toolkit of powerful, scientifically backed strategies to help us navigate these challenges more effectively. Practical methods often involve implementing subtle nudges in our financial environments.
Nudges, like gentle pushes in the right direction.
Exactly. Things like the automatic savings enrollment we discussed, or using visual progress indicators for savings goals, like those progress bars that fill up, which can be surprisingly motivating by highlighting how close you are to achieving something tangible. Designing financial tools and apps that consciously simplify decision-making by reducing complexity, minimizing choices, or making the most beneficial option the easy default choice are also key nudges. The goal is to help us work with our inherent cognitive tendencies and biases, rather than constantly fighting an uphill battle against them.
Can you give us a more concrete example of how these nudges or maybe deliberate reframing techniques might work in practice to encourage positive financial behaviors?
Certainly. One powerful technique is to consciously reframe decisions to leverage the framing effect for good. For instance, instead of viewing saving money each month as an immediate sacrifice of current pleasure or consumption.
Which feels like a loss.
Which feels like a loss, right? Actively reframe it in your mind as a gain. Tell yourself, with this savings deposit, I am gaining future security. I am gaining peace of mind. I am gaining financial independence. Focus on the positive future outcome.
Shifting the emotional valence.
Precisely. Or consider that high-risk mental account we talked about. Instead of framing the decision to diversify away from a single concentrated bet as a loss of potential spectacular gains, actively reframe the decision to not diversify. Focus on the potential long-term benefits of stability and, crucially, the significant cost of inaction, the risk of catastrophic loss, the erosion of capital through inflation, the loss compounding opportunities if your single concentrated bet inevitably fails. This reframing changes the emotional weight of the decision, making the more rational, diversified choice feel more appealing and less like missing out.
And technology can help with this too.
Yes. Personalized feedback from financial apps or tools can significantly increase our awareness of how our biases might be influencing our budgeting habits in real time. Imagine an app pointing out, you've significantly overspent your dining out mental account this month. Maybe reallocate from entertainment. That kind of targeted feedback can be very effective.
And sometimes, despite all our efforts at self-awareness, journaling, reframing, and setting up systems, we simply need an outside, objective perspective to cut through our own biases, don't we? Someone who isn't emotionally invested in our past decisions.
Absolutely. We all have blind spots. Professional financial guidance offers immense objective value precisely because a good advisor is not subject to your personal emotional history with your money or your specific biases, though they should understand biases in general.
What can a good advisor provide?
A qualified, ethical financial advisor can provide personalized strategies tailored specifically to your unique financial situation, goals, and risk tolerance. They offer continuous support and accountability, helping you stay on track. And critically, they provide expert guidance rooted in objective analysis and financial principles, rather than your subjective feelings or the latest market hype.
Do you have an example of how this professional guidance can make a real difference?
Certainly. Consider the story, let's call her Sarah Thompson, a highly successful high-earning solicitor. Despite her substantial income, she found herself feeling constantly stressed, overwhelmed by significant credit card debt, and with a sense of financial chaos rather than control.
She was great at her job, but not managing her own money well.
Exactly, a common situation. Her problems were partly rooted in unchecked mental accounting, treating bonuses as free money, and significant present bias leading to overspending. After finally deciding to consult a qualified financial advisor, they worked together. The advisor helped her consolidate her view of money, see the whole picture, identify the biases, and structure a clear, actionable plan.
What was the result?
Within just 6 months of implementing the plan, which involved automating savings, creating a conscious spending plan, and strategically tackling the high-interest debt, Sarah had reduced her credit card debt by half, built a robust 3-month emergency fund, which gave her huge peace of mind, and decreased her overall monthly expenses by a sustainable 15%. Her story truly demonstrates the potentially transformative power of objective, professional guidance in navigating complex financial challenges that are often deeply rooted in our behavioral patterns.
This entire deep dive really underscores that true financial freedom, that sense of control and peace, isn't just about earning more money. It's profoundly about mastering the psychology of money, really understanding and managing the invisible forces, the biases, the mental accounts at play within our own minds.
Absolutely.
Yeah.
By consciously identifying and starting to rewrite your internal mental accounting system, by challenging those automatic biases, you can genuinely move from a place of often stressful emotional reactivity and unconscious financial habits to one of intentional, thoughtful, and value-aligned financial action.
It's about empowerment, really.
It really is. It's about empowering yourself to more accurately identify real opportunities, to more realistically analyze risks without emotional distortion, and to purposefully create lasting financial value in your life. It involves fully recognizing that while external economic factors certainly influence our finances, our own internal biases, our psychology play an equally, if not sometimes more, significant role in our ultimate financial outcomes.
It's truly a journey, isn't it? A journey from unconscious bias dictating our actions to conscious, deliberate action shaping our future.
Beautifully put. That's the journey we hope this conversation helps listeners embark on.
As we start to wrap up today's deep dive, let's leave our listeners with a final thought. Remember this. Your financial life isn't simply a series of objective transactions and numbers on a bank statement. It's a profound, living reflection of your mind, your history, and the stories you continuously tell yourself about money.
Those stories matter.
The anxiety you might feel looking at bills, the guilt after a splurge, the relief when you get paid, or the frustration when you compare yourself to others. These feelings are often direct results of the cognitive biases, particularly the pervasive influence of mental accounting that we've spent this time discussing today.
And mental accounting powerfully shows us that true wealth, that feeling of financial well-being, isn't just about the absolute number accumulating in your bank account or investment portfolio. It's perhaps even more about the emotional space, the psychological freedom you cultivate around that number.
What does that freedom feel like?
It's about achieving a state where you don't feel constant guilt when you spend money on things you value, where you don't feel paralyzing anxiety when you look at your budget or your investment statements, and where you're not feeling perpetually overwhelmed by the endless stream of financial decisions modern life throws at us. It's about peace of mind.
So what does all this mean for you listening right now? It means that by understanding how your own brain is wired, by bravely shining a light on these hidden money traps that affect us all, you hold the key. You hold the key to unlocking a different, perhaps more profound kind of financial freedom.
A freedom rooted not just in numbers, but in clarity, intentionality, and that crucial peace of mind. It's the profound ability to consistently make financial choices that genuinely serve your long-term well-being, your deepest values, and your most important goals, rather than being subtly or not so subtly swayed by the invisible psychological forces operating within your own head.
We truly believe here at The Deep Dive that knowledge is most valuable when it's not just passively understood, but actively internalized and applied to make real changes in our lives. We've explored these hidden money traps in such depth today because we genuinely want you to feel heard in your financial struggles, valued in your desire for clarity, and truly equipped with actionable insights to take control of your unique financial narrative.
So we sincerely encourage you, after listening to this, to take some quiet time. Reflect honestly on your own financial habits, your feelings about money, and try to identify where mental accounting, or perhaps some of these other biases, loss aversion, overconfidence, present bias, might be playing a role in your life right now. That awareness is the first powerful step.
And if you found this deep dive insightful, if any of these concepts or examples sparked an aha moment for you, we warmly invite you to continue this journey of discovery with us. Share your own experiences, perhaps a time you caught yourself using mental accounting, or a strategy you've used to overcome a bias in the comments section below. Or tell us what other financial psychology topics you'd be interested in having us unpack in future deep dives.
Your participation, your stories, your questions truly fuel the growth and relevance of this deep dive community. It helps us tailor future explorations to what genuinely matters most to you and others seeking financial understanding. Every share of this episode, every comment, every subscription helps us bring these vital, often overlooked, empowering conversations about the psychology of money to more people who are seeking that clarity and control.
Join our community, empower yourself, and in doing so, help empower others to build a more prosperous, intentional, and hopefully more peaceful financial future. Thank you so much for joining us on this deep dive into the fascinating intersection of psychology and money.
It's been a pleasure exploring it.
We look forward to exploring more with you next time on The Deep Dive.